Think about it. Every time you tap your phone for coffee, buy something online, make a transfer. It's like a tiny ripple in this huge ocean of money moving around. A
Mm.
vast ocean.
And while that ocean is, what makes modern life work, it's also a massive target for criminals.
Absolutely. There's this constant battle happening kind of beneath the surface against financial crime.
And one of the main defenses we have is something called transaction monitoring.
Exactly that. You could think of it as like the financial world's early warning system.
Mm.
Really sophisticated stuff.
So in this deep dive, we're leaning on insights from FinCrime intelligence. We want to dig into what transaction monitoring actually is, how it works behind the scenes.
And why it's so incredibly important, especially now with everything being so digital.
Our goal here is really just to cut through the jargon, make it clear what this shield is all about.
Yeah, give you a good handle on it. Okay, so transaction monitoring. The name seems straightforward enough, but let's really get into it. What transactions are we actually monitoring? It's not just massive wire transfers, is it?
Oh, not at all. It's a much wider net than that. Transaction monitoring means continuously analyzing, well, pretty much all the financial activity that flows through a financial institution.
All of it.
Yeah, pretty much. Everything from your daily debit and credit card swipes, your online bill pays, P2P transfers,
Right up to those bigger, more complex international wires.
right up to those as well. The basic idea is to spot anything that looks off, anything that deviates from what's considered normal,
Yeah.
anything that could point towards money laundering or fraud or other kinds of illicit stuff.
Right, so it's not like my bank has an actual army of people watching every single purchase I make. That would be quite something.
No, definitely not. The sheer volume today makes that impossible. That's why automation is key.
Yeah.
These systems use really complex algorithms and sets of predefined rules. Their job is to flag transactions that seem unusual.
And how do they decide what's unusual?
Well, the rules and algorithms look at lots of different things. A customer's past transaction history, for one, also their risk profile, how the bank sees them,
Mm-hmm.
and of course, known red flags for different types of financial crime. You can think of the rule-based systems as good at spotting things we already know are bad, like, say, a specific amount going to a sanctioned country.
Okay, the known knowns.
Exactly. But then you have AI and machine learning. They can sift through huge amounts of data and find a new patterns, things that might be dodgy, even if they don't match an old rule.
So spotting the unknown unknowns, potentially.
Sort of, yeah, spotting anomalies that rules might miss.
Okay, so the system flags a transaction. What happens next? It's not automatic blocking, is it?
Not necessarily. Once it's flagged as potentially suspicious, it generates an alert.
An alert.
Right. And that alert goes to a team of actual people, human analysts. They then do a deeper dive.
What does that involve?
They'll look into the customer's account history, the specifics of that transaction, why it happened, other relevant data,
Uh-huh.
context. Exactly, context is crucial. And if, after looking into it, they agree that, yeah, this looks suspicious,
Then what?
then the financial institution has a legal duty to report that suspicious activity to the regulators.
Got it. So it's like this digital filter running constantly. You mentioned it looks for unusual patterns.
Hmm.
What kind of things specifically catch its digital eye?
Well, it's looking for a whole range of anomalies, things that just don't add up statistically or logically.
Like what? Give me an example.
Okay, so maybe a sudden jump in the number of transactions or the amounts in an account that just doesn't match the customer's stated income or what they usually do.
Right. Like if I suddenly start making huge transfers when I usually just buy groceries.
Precisely, that could raise a flag. Another big one is transactions involving what they call high-risk geographies.
High-risk geographies.
Yeah.
You mean countries known for weaker financial controls?
Exactly. Jurisdictions identified as having weaker anti-money laundering controls or just, more financial crime in general. Transactions going to or coming from those places get extra scrutiny.
Makes sense. What else sets off these alarms?
Another really significant flag is something called structuring. Sometimes people call it smurfing.
Smurfing, like the little blue guys.
Sort of like that, in the sense of lots of small things. Imagine someone trying to move a large amount of illicit cash. They might break it down into lots and lots of smaller transactions.
Ah, trying to stay under the radar. Below reporting limits.
Exactly that, trying to make each individual transaction look insignificant. But the monitoring systems are designed to spot that pattern, lots of small, maybe seemingly random deposits or withdrawals that, when you add them all up, equal a big sum.
Sneaky. But the system's looking for the bigger picture.
It has to. It's about seeing the whole pattern, not just the individual data points.
Okay. Are there other dodgy behaviors these systems watch out for?
Oh yeah, rapid movement of money. Funds bouncing through a whole series of different accounts in a really short time. That's a classic money laundering indicator.
Like trying to wash the money clean by passing it around quickly.
Precisely. Also, transactions that just seem weird for a particular customer's stated business.
Of course, that.
Like a small local bakery suddenly getting huge international payments or sending them. That would likely trigger an alert because it doesn't fit their expected profile.
Right.
And it's important to remember this monitoring doesn't all happen at the same exact moment.
Ah, yes. You mentioned real-time versus post-event. What's the difference for us?
So real-time monitoring tries to catch and potentially stop suspicious activity before the transaction actually completes.
Before the money moves.
Ideally, yes. This is super important in high-risk situations, and it's becoming even more critical with instant payments becoming so common. Money moves in seconds.
No time to waste there.
None at all. Post-event monitoring, on the other hand, is looking at transactions after they've already gone through.
What's the value in that, then?
It's still really valuable for spotting broader patterns over time, maybe investigating specific leads, or even using past events to fine-tune the rules and make the system smarter for the future.
So it's kind of a layered approach working at different speeds.
You got it.
Now, this term risk-based approach comes up constantly in finance. How does that idea shape transaction monitoring?
It's absolutely fundamental, and it's something regulators globally, like the FATF, FinCEN in the US, the European Banking Authority, really push for.
Okay.
The core idea is simple. A one-size-fits-all monitoring system just doesn't work effectively.
Why not?
Because every financial institution is different. Their risks are different. So their monitoring systems need to be specifically tailored to tackle the unique risks they face.
And what factors go into defining those unique risks?
A few key things. The institution's own risk appetite, for starters. How much risk are they comfortable with? Then, crucially, their customer base. Are they dealing mostly with individuals, big companies, maybe international clients? The products and services they offer matter too. A bank handling complex international trade finance has different risks than a local credit union, right?
Sure.
And finally, their geographic footprint. Where do they operate? Doing business in higher risk regions obviously requires more stringent monitoring.
And why is getting this tailoring right so vital? What happens if you just use a generic system?
Well, a generic system can actually be less secure, ironically. If the rules aren't sensitive enough to your specific risks, bad stuff can slip through. That's under detection.
Okay. Missing actual crime.
Right. But if the rules are too broad or clumsy, you get swamped with false positives.
Ah, alerts for perfectly normal transactions.
Exactly. And that wastes a huge amount of time and money. Compliance teams chase ghosts, and legitimate customers might get delayed or hassled unnecessarily. It's inefficient and annoying.
So it's about being focused, not just casting the widest possible net.
Precisely. Good transaction monitoring means having detection scenarios that are specifically tuned to the risk level of different customers. And importantly, these systems can't be static. Thresholds, rules, they need to be constantly adjusted. Criminals change tactics, so the monitoring has to adapt to new trends.
So a transaction that's fine for a low-risk customer might ring alarm bells for a high-risk one.
Absolutely. Context and risk profile are everything.
Now, we know the bad guys are always innovating. How are the monitoring techniques keeping pace? It sounds like a constant cat-and-mouse game.
It really is. But the technology is evolving rapidly, too. This is where it gets quite exciting, actually.
Oh, yeah.
One of the biggest game changers is the rise of artificial intelligence, AI, and machine learning, ML.
Okay, the buzzwords. How do they help here?
They can analyze absolutely massive data sets way faster and potentially more effectively than older rule-based systems. They're great at spotting subtle, complex patterns that rules might miss.
Finding those hidden connections.
Exactly. And what's really powerful is they can learn. They get feedback from the human analysts on the alerts and use that feedback to get better over time, refining what they flag. So AI might spot a brand new money laundering technique just by seeing a weird pattern emerge across lots of seemingly unrelated accounts.
Wow, like bringing in super smart detective. What else is new on the horizon?
Behavioral analytics is another big area. Instead of just looking at single transactions,
Yeah.
these systems build up a dynamic picture of what's normal for each customer. their typical spending habits, transfer patterns, times of activity.
A digital fingerprint of their behavior.
Kind of, yeah. So the system can then spot even small deviations from that norm, which might be an early sign their account's been compromised or is being misused.
Like noticing someone's walking funny, even if they look okay otherwise.
That's a good analogy. Then there's graph-based analytics.
Rat-based.
Yeah, think of it like mapping out connections. It looks at the relationships between different entities, accounts, people, businesses, locations to uncover hidden networks.
Seeing the web of connections.
Exactly. Visualizing these links can reveal really complex criminal structures that are invisible if you just look at transactions one by one. And like we touched on, real-time monitoring is just getting faster and more crucial, especially for instant payments.
It sounds like some really powerful tools are coming online. But I bet it's not all smooth sailing. What are the challenges institutions still grapple with here?
Oh, absolutely. It's definitely not a solved problem. False positives are still a major headache.
Still getting too many bogus alerts.
Yeah. If the rules or algorithms are too sensitive or not tuned just right, you drown in alerts for legitimate activity. That wastes resources and can frustrate customers.
Right.
Data silos are another persistent issue. Big organizations often have customer and transaction data spread across different disconnected systems.
So you can't see the whole picture easily.
Exactly. It makes getting that complete holistic view of a customer's activity really difficult, which hampers the analysis. The systems are only as good as the data they can access and link together.
Makes sense. What else?
Well, there's always regulatory pressure. Authorities keep raising the bar, demanding more effective monitoring, more proof that systems work, more transparency. And fundamentally, the criminals don't stand still. They're constantly finding new ways to launder money or commit fraud. So institutions have to be in this perpetual cycle of updating, refining, tuning their systems to counter the latest threats. It never really stops.
It truly sounds like a relentless race. We've talked a lot about security, but what about the rules? Is this just good practice, or is it actually required by law?
Oh, it's very much required by law. Transaction monitoring isn't just a nice to have. It's a core fundamental requirement under anti-money laundering, AML, and counterterrorism financing, CTF regulations worldwide.
Okay, so non-negotiable.
Absolutely non-negotiable. Regulators have very clear, very strict expectations here.
And what exactly are they expecting to see? What does a good program look like to them?
They expect robust, effective programs. That means detection rules and thresholds properly align with the institution's specific risks. They want clear procedures for escalating suspicious flags. They mandate timely, thorough investigations of those alerts and prompt reporting of confirmed suspicious activity to the authorities. That's critical. And documentation. Oh, yes. Comprehensive documentation is essential. They want to see records of how the system was designed, how it operates, how it's tested, how it's tuned over time. Everything.
Proof that it's working and being maintained.
Exactly. And increasingly, they're requiring independent validation audits, reviews to confirm the systems are effective and compliant.
So it's not enough just to have a system. You have to prove it works and keep improving it. What happens if institutions mess this up, if they fail to meet these standards?
The consequences can be, frankly, severe. Huge financial penalties are common, millions, sometimes billions of dollars.
Wow.
Beyond the fines, there's significant reputational damage, losing public trust, damaging customer relationships. That can be devastating.
Long-term impact.
Definitely. And in the worst cases, institutions can face serious regulatory sanctions, things that could even restrict their ability to operate. So yeah, getting transaction monitoring right isn't just important, it's existential.
It really underscores why this is such a critical function. Looking forward then, what's next? What does the future of transaction monitoring look like?
Well, I think we'll see a much bigger focus on something called explainable AI, or XAI.
Explainable AI.
Yeah. As AI gets more powerful and makes more decisions in these systems, regulators are going to demand more transparency. They won't accept a black box alert.
They want to know why the AI flagged something, not just that it flagged it.
Precisely. Understanding the reasoning behind an AI alert is crucial for trust and accountability.
Makes sense. What other shifts are on the horizon?
We'll likely see big improvements in cross-border monitoring. Financial crime doesn't respect borders, so institutions and regulators in different countries need to collaborate more effectively, share information better.
More international teamwork needed.
Definitely. Technologies that enhance privacy PTs, privacy-enhancing technologies might play a big role there, allowing data sharing for analysis while protecting sensitive info.
Interesting.
And also better integration with secure digital identities. If you have more reliable ways to verify who someone is online, it could really improve customer profiling and hopefully cut down on those annoying false positives.
So the trend seems to be towards more transparency, more collaboration, smarter data use.
I think that's right. Ultimately, transaction monitoring is shifting. It used to be seen maybe just as a compliance chore, a defensive measure,
Yeah.
but it's becoming much more proactive, more strategic. In this digital world, it's absolutely vital for protecting the institutions themselves and all of us as customers from financial crime.
Okay, so let's quickly recap. Transaction monitoring. It's this continuous, mostly automated scanning of our financial activities.
hmm Looking for suspicious patterns to fight money laundering and fraud.
And that risk-based approach is key, tailoring the system to the specific institution. One size definitely doesn't fit all.
Absolutely. Avoids missing things or getting swamped by false alarms.
We're seeing cool advancements with AI, machine learning, looking at behavior patterns, real-time analysis.
Yeah, technology is moving fast to try and stay ahead.
But challenges remain those false positives, data stuck in silos, keeping up with regulators and the criminals themselves.
It's an ongoing battle for sure.
And crucially, this isn't optional. It's a strict regulatory must-do with big penalties for failure.
Huge penalties.
Looking ahead, it sounds like more explainable AI, better cross-border cooperation, and maybe smarter use of digital ID are coming.
That seems to be the direction, yeah, towards a more intelligent, proactive defense.
It really highlights how central this is to keeping our financial system safe and sound.
Couldn't agree more.
All right, so here's something to chew on as we wrap up. Think about how fast financial crime evolves and how quickly technology is changing. How do we, both as individuals and as institutions, need to adjust our thinking about financial security in the coming years? It's a tricky balance, isn't it? How do we get the robust security we need without sacrificing all the convenience we've come to expect? Something to ponder.